Hi, I'm Brian.
And I'm Tom.
And we are the Dividend Dudes.
We are the Dividend Dudes. At least we think we are.
We still are.
We still are. So, past couple videos we've been talking a lot about, I guess we've been buying a few stocks. We've been doing one per month now.
Yep.
And this month
three?
Month three, yep. So we have a massive portfolio at this point, three total stocks.
$400 each.
$400 a piece.
So we're talking like maybe 2 stocks of each.
yeah. So there's not a lot going on with the portfolio at this point, but we are continuing on the trend of buying one stock per month. So the idea this month is we're going to be buying another one, and we're going to do it based on what we did in our last video where we kind of covered the cash flow statements. We're probably going to have to go through that again because there was all sorts of rabbit trails in that, and I don't want people to lose sight of what the purpose of that video was.
There's a ton of line items in the cash flow that you could go through. So to go through each one would be like an hour-long video on each line item.
So we'll try to revisit that to clarify some things, or at least help it make more sense. Maybe repetition is key there, I'm not sure. But what we're doing this time around is we're going to buy a stock, or at least we did buy a stock, based on what those cash flow statements were showing. And just full disclosure, that stock was General Dynamics. We bought $400 worth, but it wasn't enough to buy 2 shares. And the platform that we're on right now doesn't allow fractional shares, so we went over just a little bit. We ended up buying 2 shares, so we have to take $50 off of our purchase next month because it ended up being about $450.
Just trying to keep it real here.
Yeah. So we got 2 shares of General Dynamics that brought our dividends per week up to about 82 cents per week.
Nice.
So we're
rolling.
We're rolling.
We're balling, baby.
82 cents gives you 82 horsey rides at Meijer or something like that.
It's still a penny at Meijer.
That's probably just enough time.
For all of you people out there that don't live in Michigan or Illinois or Indiana, Meijer is like a Walmart. But better.
That's right. For all 15 subscribers.
Who are probably in Michigan.
Probably all in Michigan. So 82 cents, I would think that's probably enough time to be at the store, get on the horse ride, if it's me on the ride, to have the manager get notified and come back and say, hey, you need to stop riding that ride.
Mister, there's some kids who want to ride this.
And they're all crying, probably. That's great. That would probably be just like me. But
I wonder what the weight limit on that is.
Hopefully not. Hopefully I can handle that.
I know there's some
or can handle
chunky
me.
kids out there, so maybe.
So we have 82 cents a week coming in. We purchased the stock, and right after that, the markets. This recording in particular, we're still playing catch up on when we release videos and when we record them. We're getting closer, but right now it's June. So if you're following what happened in the month of June or what's happening right now, the stock market it took a big dip early on in the year, and it's taken another huge dip too. And
Was it down like 25%?
Yeah, it dropped like almost 10% this week.
Yeah.
Between the NASDAQ and the Dow, they dropped a lot. So the reason for that, there's a whole bunch of reasons. Ukraine has, basically they can't get their grain shipments out because of the war. And now everybody's afraid of 15%, of the world's food production is just stopping. So that's going to create a food problem. And we've got gas prices. I filled up my car today and it was like $100. So there goes my 82 cents.
$5.19, I think, for regular.
Yeah, it was expensive. So I mean, there's food problems, there's fuel problems. It looks like we're also running into an issue with the Fed raising the rates. There's some concern about them doing it too quickly. They're talking 0.75%.
Yeah, 3/4 now, and then later in the year there's going to be more.
Yeah, so that may not have the negative pressure that people are thinking it is, because job reports still look pretty good. The biggest issue that people are talking is inflation, because the prices are just going through the roof, and the salaries that people are getting at their new jobs is not commensurate to that inflation. So as a result, people in the market, as we said before, people tend to anticipate with stocks what they think it's going to do over 6 months. So what's happening now is people are panic selling and they're not being very logical about it. That doesn't affect me and it doesn't affect Brian. We're not panic selling our stocks. We bought a stock.
Again, you only realize a loss, even though the value goes down, you only realize a loss when you sell, and now it's gone. So don't sell unless you have to.
And that's important to, when you're looking at selling a stock and when you're looking at buying a stock, this is exactly why you buy companies that have a solid product, a good line of business, and have a good balance sheet and are actually profitable. Because if you don't, it's almost like what Warren Buffett said, when the tide goes out, you find out who's swimming naked.
Right.
All these companies that are based on hype, they don't have a product, they're negative assets, or they overextended themselves. You're going to see that right now. So we buy very boring companies, and yes, I realize, I had somebody bring this up to me. So I give you $1,000 and you pay me 82 cents a week. To me, I'm thinking, well, yeah. And I think I mentioned this in the last video, but it came up again, and I says, well, yeah. I said, you got a car loan, right? And he goes, well, yeah. I said, so wait, you gave the bank, or I'm sorry, you wanted a car, so the bank gave you money, and then you did what? You paid them, I guess if it was the same, it'd be 82 cents. You paid them 82 cents a week to have your car, right?
Right.
So how's that different than me buying a stock and giving, in this case, General Dynamics or Merck or AT&T, we have 3 stocks, giving them a loan and having them pay us back the loan. So he, again, thought, this is a different person, different he. He said, oh, that kind of makes sense. He says, it does, if you hold on to the stock a while.
Right.
I see a lot of YouTubers, I see a lot of influencers, I see a lot of people in the market that are basing on, support and critical, breakthrough levels, and they're all technical and stuff, and they buy and sell every month. Well, there's a couple things that are going to happen with that. As we mentioned way back in the first videos, you've got transaction fees. You've got capital gains. If you hold taxes are big. If you hold a stock for less than a year, you're going to end up paying income tax rates because you sold the stock before the year was up.
Right.
If you hold it for longer than that, you're paying capital gains rates. It's a much lower rate. And if you've earned this money and you've paid taxes on this money already, why would you want to pay taxes on it and transaction fees again? So
yeah, the only way that works is if you are a day trader and you are making more on the margin than you would in the taxes. So in overall, you're making more. And if you held on to that stock, it's it's going to go down. You're going to lose all of it. So that's time sensitive and
hard.
It's very difficult to do, and there's very few who win at that.
Yeah,
I mean, that's gambling at the core.
Unless you're really super good, like psychiatric or what do we call it? People who can read each other's minds.
Like
what is that?
ESP.
Yeah, unless you can read people's minds and figure out what somebody's going to do, then you're basically gambling. So,
right.
The point we're making is that yes, the market's going down. There's a couple things to know when the market goes down. Sometimes, not every time, sometimes dividends go up. If a company declares their dividend on an annual basis, let's say you've got and this all messes with earnings per share and all the price to earnings ratios and stuff that we talked about too. But if a company says, hey, we're going to pay out a 8% dividend for the whole year, for all of 2022 in this case, we're going to pay this 8% dividend. Well, from January until now, let's say that stock and their earnings stayed the same, still making whatever they're making before, that stock dropped 30%. Well, you're still going to make your 8%. You're still going to get your check. So it's not like AT&T and Merck and the General Dynamics that we purchased. We purchased. If you want to purchase stocks, please consult financial advisors. We have to say these things.
Yes.
So please make sure you do that. Make sure that's in line with what your goals are personally. But when we buy these in our portfolio, we're still getting that 8%. So we buy these companies, we're doing okay. But if we buy the stock as it's depressed relative to their earnings and they already declared their dividend, your dividend check is huge by comparison. So normally a stock that would pay 2% dividends, if they go down 40%, they're somewhere around like 3.5 now. Look at like Campbell's Soup, Kraft, DuPont. They declared their dividend already, but the dividend has gone up because their earnings are the same, but there's less people that have the stock. Remember that earnings per share ratio. So if there's less people that have the stock, their earnings are the same. Earnings per share looks better. The dividend that gets subtracted from that number is less. So the numbers start looking better. In fact, even some of the ones we went through in video, I think it was 4, like Lumen Technologies, I dragged on them, and I still have stock in them. I didn't sell them at that time because right now, if you look at their finances, they look pretty good.
Right.
I mean, it looks pretty decent. They fixed the problems that they were having. The basically the people that were swimming naked and got out of the ocean, and they're looking better now. So when we buy stocks, we just like we talked about before, long term. Yes, 82 cents a week may not seem like a lot, but you're starting a snowball that's rolling down the hill.
Well, just last month we were 42 cents, so we're doing much better.
Yeah, I mean, it's not like it's a huge amount, but you're starting that snowball. You never have to. Well, hopefully, you never have to work for that 82 cents again.
Right. It's,
I mean,
income that persists.
And how do you become successful? Well, you just keep doing it.
Yeah.
If you keep adding money to it, you keep making sure you're buying solid companies. Over time, that 82 cents becomes $8, then it becomes $80, then it becomes $800. If it was $150, well, that's most people's cell phone bill. So like if I got a cell phone here, that pays for my cell phone bill. Now, am I going to do that? Am I going to take the dividend check and am I going to pay the cell phone bill? Well, if I'm really hurting financially, maybe.
Right.
Maybe you need to do that. But if you don't need to do that, what do? You just reinvest it. So what we're going to do with these dividend checks, because we don't have any need to really spend them right now, is we're going to reinvest them. Now, if you don't have very good financial fortitude to just watch the money grow on a balance sheet, I'm personally not opposed to taking the dividend check. You do pay taxes on this if you do it, but you can pull it out and you can go get some ice cream, go have a date night, do something fun with it just to reward yourself for saying, hey, I was responsible. I did something good with my money.
Right.
And that's kind of the premise of this, and that's also why we say that long term, keep hyping on this long term, because what happens? The market's crashing now. Most recessions, if you look at the history going all the way back to like just after World War I, they had the 20s and the 30s,
the Great Depression.
Great Depression. You look at Black Tuesday and all that. It's about 18 months. Some recessions are longer, but what they're talking about today in the media is somewhere around 18 to 21 months. So whatever's happening now will probably fix itself. We hope.
We hope. Yeah.
We hope it'll fix itself.
Historically speaking, has always had a correction to a dip.
Yeah, so if you're getting dividend checks for that 18 months period, there's very little incentive to sell. The incentives to sell, had these questions a lot. Brian's had this question too. When do you sell? Well, you don't try to sell.
Right.
You can, but there's got to be some circumstances that surround that. We can talk about those.
The company is destroying itself,
or they do something stupid. But again, if you buy a company that's based on consumer commodities, stuff that people actually have to have, toilet paper, deodorant, soap, what's things like that.
And companies that have been around for a while.
Right. Yeah.
Know how to keep their business going, longevity.
Yeah. So like the AT&T or Verizon or Sprint or any one of those cell phone providers that are out there, people kind of need to be able to communicate. So chances of that business model going away are pretty small, especially if they're huge, like big companies. And back to the previous videos again, size matters. So if you're going to talk about buying a really tall or small, not tall, it's a tall company. Really tall company. They have very tall buildings.
Is this Starbucks here? The tall is a new small?
Their warehouses are 50 stories at a minimum. Only 50 stories. If they go below that, they don't build the building.
There you go.
So, correction, small. small companies.
Startup.
Yeah, so if you're going to buy a small company, they're going to be volatile based on that if they're not a consumer commodity. If they are a consumer commodity, you hear a lot about vertical farming and stuff right now. There's a lot of small companies trying to get into that. We talked about this again in another prior video about, okay, if you could pick the correct automotive company, which would it be? It's very difficult to do that. You're going to have to find one that has what would be called a good defensive mode. Something that can, basically afford to weather the storms and has enough market share out there that it's going to take a while for that to correct itself. So if they have a good market share, Ford is a good example, or Honda, if you're talking automotive, Tesla, they've got pretty good market share now. But there's Toyota. Yep, Toyota's got a pretty good one.
Well, Volkswagen is one of the most.
Yep. I mean, any car company out there that's got a pretty good market share, it's going to take a while for that to correct. So you'll have time to sell the stock, especially if you buy one that's doing well financially.
Right.
But if you're getting a dividend check, if I'm getting
What's the
paid,
incentive to sell it?
right? If we're getting 82 cents a week. I can't wait till this is more, because it's more exciting when it's more.
We're making $3,000 a month.
Yeah, so when you're getting, let's say it's 3,000. Let's say you're getting $3,000 a month, and that's not going anywhere. If the market goes like this, what are you gonna? I mean, do you really want to sell?
I don't want to realize those losses, and maybe it's better on my taxes because now I've lost a lot of money, but I don't want to lose that money, and I haven't if I don't sell it. So I'm going to keep that in there, going to keep getting the dividend checks. And there's a really cool thing on most firms is automatic reinvestment. So I check that box. I don't have to worry about it. It automatically gets reinvested back into my stock. I get more stock. All the stocks are going down in value at the moment. So now you're getting more stock for that money.
Bigger dividend per share too.
Bigger dividend. So when it comes out of the recession, hopefully it's just a recession and not a depression, then I'm better off than what I started. And
Right.
if I can, and I still have that $400 a month, I'm still buying stocks during the dip. Because now, instead of buying 2 stocks, I could buy 3 or 4. I'm doubling my stocks.
That's another point to make, that the $400 a month that the average person has, we'll reevaluate that every year. We'll probably rehash some of the things we talked about too. But when the stock market crashes, people think, oh, it's a great opportunity. Yeah, it is a great opportunity. But the reason why the stock market crashes is because people are losing money.
Right.
Like it's not often the case that you're just going to be sitting on a giant pile of cash when the market, crashes because, oh, now I can buy. That's really not very common. Because if you do sit on a giant pile of cash, and we're talking inflation, you just got eaten alive last year. You lost, like, over the past 2 years, you've lost almost 20% of that value just in inflation alone. So sitting on cash just to make that big fat pitch,
that's hard to do.
That's hard to do.
Especially if you're just starting out, you're the new investor, and you only have that 400. You don't have that big cash flow. This is it. And as gas prices go up and food and other things that you need to pay, maybe that 400 is now $200.
Yes.
Because of cost of living.
And we're not investing like billionaires invest, right? Because they, if you're Warren Buffett or something, you're going to buy. You can afford to sit on millions and millions and millions of dollars.
Completely
and then
different strategy.
They're very different because they can come in and sit down at the board of directors and say, you're going to do these things. Well, if you walk up to ExxonMobil or Chevron or BP or AT&T or something, and you sit down at the board and say, I got $400. Can you guys give me that corner office over there?
I got 5-year stocks. I want to talk about how you run your company.
Yeah, they're probably gonna see you out the door.
Yeah.
I'm thinking. So we can't invest that way yet. So the idea is, you want to make sure you're playing defensively. You're playing to the strengths of what we call dollar cost averaging. There is a little bit of a difference between the way Brian takes his dividends and the way I do. I don't automatically reinvest my dividends. I have a little bit more active management on my portfolio. If you don't actively look at the finances of the businesses on a monthly basis, automatically reinvesting the dividends isn't necessarily a bad way to go. What we do in the Dividend Dudes is we don't automatically reinvest, because we're taking that and we're sharing with all of you what we're doing. So we'll take the dividend and then we'll take the 400 and we'll add those two together, and then we'll invest in the next one. So as time goes on, that should get, hopefully
It's going to keep going up.
should get big.
And it's going to incrementally go up.
Yep. And it's not a it's a lot easier when it takes, I think, every Excel spreadsheet I've ever looked at doing this, it's usually around year 6 that you start to go, wow, this really is doing something.
Look at all the money.
And then by year 12, year 13, I've been doing it for 16, 17 years during this Christmas. It's June, so I've got a few more months yet. But then around year 12, 13, you're like, holy cow. I mean, it's the dividends are more than I was actually putting into it.
Right.
And then so the law of averages, they say the stock market doubles every 7 years or something like that. Some companies, if you do it right, you might get 5 years out of that. So, and that includes the dividend. So 82 cents per week that we're getting now because of inflation, if they charge more for my cell phone plan or for a toilet paper or soap or whatever we're buying, or those, we bought Merck was one of them, the medicine you use. Maybe you have to take Tylenol or whatever. I don't know what Merck makes in that realm. So, but whatever they do in terms of the product that they're selling, don't get lost in the fact that I said Tylenol and Merck might not be the one that makes Tylenol. Disclaimer. But the point is that if they sell a product for $1 each, and the inflation causes them to sell that product for $1.50 each, well, their revenue increases, their earnings per share increases, and their dividends based on a percentage. So if it's based on a percentage, guess what happens to your dividend? That 82 cents becomes maybe $1, maybe $1.10. There's other companies out there that make it a very fiscal point. They pay a lower dividend. DuPont's a perfect example of this. They've paid the dividend back for 66 years consecutively. They have increased their dividend. So if you're getting $1 per month on DuPont stock, next year it might be $1.05. Next year it might be $1.10. Next year it's $1.15 on top of the inflationary changes. So that's another kind of hidden benefit to doing this versus just putting money underneath your mattress or, underneath these really cool theater chairs that Brian has. Yeah. So that's kind of the point. We bought General Dynamics. We want to harp on people just understanding that when the market crashes, that's a good opportunity. Don't freak out because your $1,000 is $900. And in fact, even if you look at our portfolio, we'll post some during the video. We'll post some things here, wherever Brian posts them. But we'll actually show the performance of the portfolio, and it's been pretty good. I mean, it's kind of flat, but it's not really going anywhere. So if you look at it's flat, and we're getting 5% dividends or 2 or 3% dividends, we're still growing. So that should say quite a lot. I mean, if you've got the market crashing 30%. And the portfolio that we have with all 3 months of investing is giving us a, kind of a flat return. That says a lot by itself. Right. But then on top of that, we have dividends coming in. So we're doing pretty good.
Yeah.
And hopefully that continues.
I would agree. And I gotta just stress, don't panic sell. Whatever you do, if you take anything from this video, don't panic sell. Because you're going to lose a lot more money than you would if you would have just held on to it.
Yep. Unless it's crypto. We harped on crypto a lot, but there was a good reason back then.
Now, people are harping on crypto. It's like, all the naysayers are, it's not going to last. It was never going to last. It's, supposed to be the replacement to the dollar. And look what's happening. It's down 50%. Yes, it is. But what they neglect to say is the economy's down.
Everything
Stocks
else is
are down. There's uprest.
Uprest?
Not uprest.
Like tall buildings? No, we have uprest, not unrest.
Unrest in the world, and all this other stuff is happening. Bitcoin is not immune to all this.
It trades like a tech stock for a reason. They develop software. Their software algorithms are kind of what make the whole thing work.
Yeah. But again, when I say don't panic sell your Bitcoin, because now you're realizing the loss of what you had. I mean, unless you bought Bitcoin at $1 and you're still making $600,000 or $1 million, then sure, go ahead and sell it and realize those taxes. But don't panic sell your Bitcoin. I mean, if it's like Luna was a scam, and stuff like that,
that's different.
Then that's different. But if you invested in Bitcoin the way we invest in stocks, then you have decent companies or decent software makers that are going to be able to weather the storm as well. So Bitcoin, I think, Ethereum's going to go up. Ethereum 2, when it comes out, I think will be good. But
they have to weather through the Fed regulation,
right?
And they have to weather the current downward trajectory of the market. So they have to do that. I'm still not a fan of investing in crypto. We were right; it was going to drop, and it did. I mean,
pretty big.
Bitcoin went from, I think, one of our earlier videos, it was like at 50 some odd thousand. Now it's like 25. So it dropped a lot.
20.
Ooh, it dropped even more. I checked it 2 days ago. Now it's like, ooh, 20% down.
I bought Dogecoin because it's fun, and I had some cash lying around. So I bought it at 20 cents. It's
Can I
now
have some
down
of the
to
cash?
It's now down to 5
Some
cents.
cash lying around.
No, it's
You got cash money. Okay.
no.
Keep going. I'm sorry.
So it's hidden.
Oh,
It's not just lying around. Oh, anyway.
like Mo money.
But I'm
Got
not
my
gonna
cash.
sell it because I don't want to realize all those losses. I'm gonna wait it out because I don't need that cash right now. So I'm just gonna let it sit, and maybe a year from now it's back up to 20 or more, and I can keep going.
I should say that's an important point, Brian. I've said this a lot.
That's a good point,
That's a good, important point. Good point.
Good
It's a
point.
good point.
It's a good
That's a good point, Brian. If you're just starting out, my recommendation and our recommendation is don't start with Bitcoin.
Yeah, don't buy crypto unless you're fully established and you have just some cash that you could give to somebody on a whim. Use that because now, or if you're going to go to the casino and play some slots or whatever, use that money that you can afford to lose.
But if you're just starting out and you don't have those kinds of dividends coming in, do kind of what we're doing. I mean, that works. It actually works. You get your dividends, you're based on boring stuff. Sure, it's not exciting. I mean, who walks around saying, I own a toilet paper company? Like,
It's like I own Tesla, but Tesla doesn't give dividends. So as far as value stocks, it was a very good value stock.
It was.
You bought it, it went up 3,000%, and you would have made quite a bit of money.
And all of the competitors took note.
Yeah.
And they're all producing electric cars now.
It's dropped with everything else, but
so
all the people with value stock, I think they're the ones who are panic selling because all their value is built up in the stock itself.
yes.
So when that goes down, they're losing the value of all their money and they're not getting the dividends.
They don't have a reason to hold on to it.
Right.
And that's
So now it's cut my losses so that when it drops, I could get back in at the low point and build back up.
But how do you play that? I mean,
hard.
I've tried dry vesting. I've tried buying stocks that don't pay dividends, and you become very emotionally attached.
Yeah.
Like you get really tied into the whole, oh, it's up today, and oh, it's down today, and I mean, like if it drops a lot, you're thinking, oh, I just lost my shirt, and that's not. I don't want to lose my shirt, but that's not how you invest. That's not an investor's mindset. I mean, if think about if you were the actual owner of a company, and you had built this thing, right? You're building this company and you're trying to put together buildings and assets and employees and get a customer base and get a product out the door, and you're trying to make something happen. And every time some investor came along and goes, well, your bathrooms are dirty, so I don't think this is a good company. And then everybody else goes, oh my god, and then they all sell the company. Are you just gonna quit your job?
There goes your value.
You're not gonna stop building the company. So why would you do that with a stock? I mean, you're not gonna just say Tesla is just the awful company because they dropped and they went to 1,000, now they're 800 or whatever. I mean, that if you work there, you're probably not going to do that. But everybody who tries to play the market, that's what happens, is they get all this emotional tie to the actual dollar value and they forget what the dollar's tied to. Like the price of the stock is tied to the actual business. Not all the time because of the people who play the market that way.
Right.
But most of the time, when you buy a company, there's some book value tied to that share price. Bitcoin, companies that don't pay dividends, usually the small caps, the OTCBB, the pink slip stocks, sometimes like the SPACs, that are out there, they're not necessarily tied to a product, so that they can do this, and they can do this very voluptuously,
right.
like very volatile. They can do it very. The volatility of those is very high. So when you're starting out, that's not where you want to start, because I mean, can you imagine this? You only have $400. You don't have any dividends coming in. I remember what that was like.
That's stressful.
I started with basically nothing. So I mean, when you start with nothing and you give them what could be basically, hey, my car needs brakes money. stuff like Fred Flintstone otherwise. But you give him that money and you see that going down like that, that's
I just lost half my money that I just gave you.
Yeah, I could have put brakes in the car for that. I mean, you don't want to be that person. And so when you're investing, I learned that the hard way. Take it from me. When I started this early 2000s, like 2001 through 3, I was doing this. I didn't really have any concept of how to wisely invest. There was a couple stocks I bought, and I had a really cool car. It was a Geo Metro, barely did 70, little 3-cylinder, but that thing, it needed brakes, and that's exactly the example. It's like I wanted to buy some brakes, so instead I bought some companies, and they didn't pay dividends, and I watched it do this. Now, thankfully, I made good decisions on the company, and they went up, and I was able to sell it later. But it was a hard lesson that was learned. That you don't want, when they say don't get emotional about stocks, boy, it's true. And what's happening in the market is everybody's getting emotional. Recession's coming, all this stuff is terrible, and we're gonna sell. I'm gonna take what I want. Well,
sell, put it into gold.
Right now, the smart people, myself included, are getting very greedy with what they buy, because the dividends the dividends relative to their earnings are higher. Everything's on sale. So as long as you still have a job, you're still making money. Yeah, now you buy.
Yes.
But again, when the stock market goes down, people are losing money. There's job layoffs and stuff. So the first thing to do, we were 3 months in. We bought 3 stocks. Before you start buying stocks, please make sure you don't have a credit card that has a 21% dividend or negative dividend interest rate that you're paying. So if you've got a credit card, pay that off first. Then buy the stocks that pay 2 to 5 to 8% dividends, because then you're actually, letting the money work for you. But if you've got huge amounts of debts on the other side, pay those off first. Because again, if back to that car brake example, if you take $400 and you have that credit card payment, and it does this, well, now you can't pay off your credit card, so you're even more stressed out than you were before.
Going back to video 2 is pay off your debt first, then start investing.
Yeah, and then we apologize again. Brian doesn't want to. I apologize for the first videos. When you get in front of the camera the first time, you get nervous. Like, oh my God, people are going to watch me. Well, I mean, you get used to it. Hopefully we're getting better.
It's going to be video 1000. He's going to be still apologizing for videos 1 through 50.
Probably.
I'm sorry for video 5.
But go watch it anyway.
It wasn't very good. If you want to see something that we did that was crappy, that's a lot worse than what we do now, go look at that.
But the content of the videos should be good.
Yeah.
Video 2, the stuff that we talk about, there's some pretty solid things in there that if you're trying to get started on this, that you need to accommodate for. Don't buy DuPont or Merck or AT&T or General Dynamics or any of the ones that we did buy in the dividend use portfolio. And we can, again, flash that somewhere here in the video at some point. We'll figure out where. But don't buy those if you've got big credit card payments. 82 cents a week isn't going to do you any favors when you're paying your Capital One card or your basically your credit card at 20%. I mean, it's
use that $400 and put it on your credit card bill. So if you've got a $5,000 credit card bill at 18% and you're making the minimum $35 a month, it's going to take you 10 years to pay that off, and you're going to end up paying $10,000 in interest. So use that $400 and put that on that credit card bill to pay it off quicker. And then when that's paid off, don't use it for everything you got. Yeah,
you could do is you could have a credit card payment, and then you could buy the stock that for the credit card company.
Well, there you go.
And then when the bill
get your money back.
Yeah, so when they call you, you could be like, well, I own stock in a company, so you just pay the dividend towards my debt. Let's see what happens.
Yeah, that'll work great. Yeah.
But so you wonder where the dividends come from if you're a banking company. That's where they come from. They come from
Interest.
These payments.
Great. Credit cards are great for if you could play the points and all that stuff and get the rewards. And if you need to buy something in an emergency, it's great for that. But unless you could pay it off every month, don't use it for everything that you don't have cash for. So, we
Takes
have
discipline.
Credit cards, and we buy things with credit cards because it's a lot easier to make purchases than with cash. Like, especially if you're buying things on the internet or whatnot. But we have the cash build up to pay it off every month, and we don't ever pay that interest rate because I'm sorry, but it's stupid to pay interest. You're paying extra for the use of their card now, and just pay cash, and you won't have to pay that.
And they're not low rates.
No.
I mean, card rates are just unbelievable.
We've got
They're
really
high.
good credit scores, and above 800, like 820. I mean, it's like really good, and we're still paying 12%.
But for a credit card,
13%.
that's really good.
It's good for a credit
for
card.
a credit card, but that's still
That's
crazy.
still a lot.
That's
a
crazy.
lot of money that you're just paying off just because you didn't pay off your credit card.
There's a couple of REITs that are out there. AGNC is one of them. Anali Capital is another one. I think IET is another type of one. The real estate investment trust companies, they're stocks. You buy the stock. They're required by law to pay you a certain amount of their proceeds and profit back in a dividend. So to give you an idea of how high this credit card rate actually is, the highest I've ever seen them is around 15%. That's high. I mean, that's really high. Now granted, buying a stock that pays that high of a dividend, there's some risks to that because that's a lot of their profit. Remember the earnings per share video?
Yes.
You subtract the dividend from their net income, so and then divide that by the number of shares that are out there. So if you have that, you're going to be very hard pressed to grow the company. So REITs are a little different that way, but the highest I've ever seen it was 15%. That's right now, and Alley Capital pays 15.4% because the market's just gone basically to pot. I mean, it's crashed pretty bad. But usually they hover around 9 to 10%. So you can have an 800 credit rating or higher. High five, Brian.
That was
Good
weak.
for Brian. That
Weak.
was really. I'm a nerd, so I can't give like muscly high fives. Yeah.
You pulled away.
I did.
I feel so used and unwanted.
We'll get better at those too. So if you have an 800 credit rating and you've got the lowest possible rates on a credit card, the interest on that credit card is still higher than some of the highest paying dividend stocks that you can buy on the entire stock market. So don't have that kind of debt if you get into this.
Right.
But in the meantime, we have 3 stocks. We bought AT&T for month 1. Month 2, we bought Merck. And then month 3, we're buying General Dynamics.
That's called diversification, buddy.
Yes, actual industry diversification. Not what we had mentioned prior, where you buy all one industry. So we're probably going to rehash some of the cash flow statements in future videos. We'll probably go through and look at balance sheets following that, and then we're going to continue on the trend of buying 1 stock per month, just so people can see how this builds up. And I think this is month 3, so AT&T should be paying us a dividend by the time we do the next video. I think.
Yeah.
Got like a whole $1 or something crazy, huge.
And if you're playing along at the home game, go ahead and post in the comments what you're making for dividends.
Yeah, we're all about that. So.
Yeah.
We also have, if you want to actually post something down there and say, hey, what do you guys think of this stock? If there's enough comments, we might get overwhelmed, but I mean, we'll look at it as many as we can, and then maybe we'll talk about those in the videos here so you can actually see what we think about them financially.
Share your successes.
Yep. And the reason why we're investing in these stocks the way we are, so that if we mess up, it's literally our money on the line. We're putting this money into it, so you can see that, look, we're invested as much as anybody else. There's a lot of people that talk finances and stocks, but we don't own any of the shares that we recommend in this article. So why are you recommending them?
Right.
Like, what's the point?
Learn from our successes, but also learn from our failures.
Yep. So there's hopefully some good things that are coming now that we kind of got a pretty good flow. I'm not as nervous in front of the camera. I don't think Brian was ever nervous.
I was.
You were? Really? There's some vulnerability there,
show.
Brian. I think people will love that.
Yeah.
Brian is a giant teddy bear.
I'm usually very laid back, so maybe it didn't show.
Yeah, he can high five better than me too. But so I guess that's all we have for this video.
Yeah.
We'll keep going. Next time around, we'll probably talk a little bit more about cash flow. Maybe we'll talk a little bit more about what the market's going. Not real sure yet. So we still got to catch up on some of the previous videos just so that they're a little bit more current to what we're doing. Thank you for watching. Please subscribe if you got. Tell your friends. We are not monetized yet, so the more that we get there and the closer we get to monetization, we're going to try to make it so the ads are not all over the place and over the top. But if we get monetized, we can actually spend more time doing this. We'll get more ability to maybe look at the stocks with people, maybe analyze this stuff more. So that's the intention long term. I understand that's long term, just like an investment, it's long term. So again, please like, please subscribe, tell your friends, and then if they like this, great, then we'll keep going.
And as always, happy investing.
Happy investing.